So let's say that you're just getting into investing and you're trying to figure out whether you should be buying ETFs, index funds, specific stocks, and specific companies, because everybody out there will tell you what you need to go buy. And they'll be like, you need to buy this stock, you need to buy Tesla, you need to buy freaking Costco. Or they'll say, you just invest in the S&P 500 ETF. Well, I want to break down at least my understanding of the difference between these things and the potential benefits and drawbacks of each of them. And so let's just start it off with what is the difference between buying an individual stock and an ETF or exchange. What does it stand for? Exchange traded fund. So an ETF or an index, these both do the same thing. They basically track a specific industry. Like, for example, the S&P 500. That's like probably the most famous one. It stands for Standard and Poor's 500. And so these are the top 500 companies in the market. And so it tracks the top 500 companies in the market. And when the top 500 companies together have growth and do well, well, the ETF has growth and does well, basically. And when the top 500 companies go down together, well, then the ETF or an index fund that tracks the S&P 500 will also go down. Think of it like an average of the top 500 companies. But they have index funds for and ETFs for a lot of different things. There's Bitcoin ETFs. There's ETFs for certain markets like AI technology ETFs. And each one of these uses this same principle. It tracks a specific market and it has the top whatever. Some of them are different. Like there's like you have to like read into the description of the fund and it'll tell you exactly what it tracks. Like top 1,000 or top 2,000 companies. Or there's some funds that will track international markets, some ETFs that will track international markets. Why would you want to invest in that as opposed to a specific stock? Because when you invest in a specific stock, you are putting all that entire investment in one company, not in a multitude of companies, and then it like not into something that's tracking a multitude of companies and then going up or down based on the average of all of their growth. Well, I think it comes down to, in my opinion, how active you want to manage your portfolio, like how much risk you're willing to take on, how much activity that you want to have into researching companies as well, and how much time that you want to put into your investment life. And so here's what I mean. If you're okay with just getting 7% returns year over year, and your plan is to just put money into the market every month so that it can grow at a 7% rate over the next 30 years, then yeah, probably just put that into, the S&P 500 ETF every month. Just do that, and then you don't have to think about it. All you have to do is remember to put your deposit in. And as long as you leave it in there for 10 years, you will get that 7% return on average year over year. Some years you might get a much higher return. Some years you might get no return. But if you leave it in for 10 years, that's when you can expect to see that 7% return year over year. And that's in the S&P 500. The great thing about this is you don't have to track individual companies. And here's what I mean. Let's say that a company is doing really well and it's included in the S&P 500. It's one of the top 500 companies. The ETF is actually tracking this company. Let's say, for example, Robinhood tried to make it into the S&P 500 just a couple of weeks ago, and they didn't. And but let's say that Robinhood made it into the S&P 500. That means that all the ETFs that are tracking the S&P 500, how well Robinhood stock is doing would influence that, along with the other 499 companies in there. But let's say that all of a sudden Robinhood makes some really bad decisions and they go out of business next year. They start just doing terrible. right? Well, eventually what's going to happen is they will drop out of the S&P 500 and they will be replaced with another company. So if you are investing in something that is tracking the S&P 500, you don't have to worry about selling your investments because they're starting to do bad. The individual companies that are starting to do bad will be removed from that fund. They will stop being tracked and another company will take its place. So you can just keep putting your money in year after year. You don't have to worry about constantly checking to see how the company is doing and deciding whether you need to sell this now or if it's going to go down to zero. For example, let's say that you had stock in Circuit City, or better yet, even wider known. Let's say that in the 90s you had stock in Blockbuster, but you bought it individually and the stock was going up and up and up. Let's say it's 1990. People are going to Blockbuster. They're renting movies more than ever. It's 1995. Everybody has a VCR now. They got DVDs. DVDs just came out. Blockbuster's got these DVDs. You can go rent them. Your stock's doing well. It's doing good. You're getting a good return. But the thing is, you only make that return when you actually sell the stock, right? That's how you realize those gains. It's just paper returns until you finally sell it and get your gains. And let's say that Blockbuster did so well over the 10 years that you held it, and Netflix comes out. They start shipping DVDs through the mail. That's how they started. And less people are going to Blockbuster. They're just getting their DVDs sent to them at home. And your Blockbuster stock starts going down. All of a sudden, streaming comes out in the mid-2000s, early 2000s, goes down even further. Blockbuster goes out of business, becomes insolvent. Your stock goes to zero. It didn't matter how well your stock was doing in 1995. You had to sell it before it went down to zero. You had to have the wherewithal to be like, okay, like I can see what's going on economically in this whole entire marketplace, and I can look at Blockbuster's balance sheet, their income statement. I can see where this ship is headed. It's time to jump off before it crashes into the rocks. Let's take the profits that I have right now, even though they weren't as high as what they were in 1995. Let's just take what we have right now, sell it, be done with it, and then if we can let this ship just totally, it's time to abandon ship before it crashes, basically. And if you didn't do that, well, you crashed into the rocks with the ship. And so this is the risk of investing in individual stocks. You have to pay attention to them so that this doesn't happen. And if you're only investing in ETFs, well, you don't have to do that because they track more than one company. They track a broader range of inside of specific submarkets and markets. I personally have some ETFs, but I also have stocks in somewhere around like 40 different companies, 40-ish. And because I have those, I have to look at them. I have to look at the balance sheets. I listen to the earnings reports that are coming out, the quarterly earnings reports. I pay attention to the news on what's happening with these companies, especially the ones that I'm holding larger positions in. Some of them I'm holding tiny positions, and I'm just like checking them out. And it's like whatever, like $10. I really don't care. But the majority of the ones that I'm holding larger positions in, I'm paying attention to basically on a daily basis. I'm not making decisions and doing things, buying stock and selling stock, but I am keeping my thumb on the pulse of these companies. And if that's not the kind of investor that you want to be, then I would encourage you to maybe just invest in ETFs. But either way, I'm not a financial advisor. Don't take my advice. This is just education. Do your own due diligence. I'm just sharing my opinions. But basically, that's the difference between stocks and ETFs. And if you want to hear just a little bit about one of the stocks that I am totally bullish on right now, and this is just my opinion, check out this video right here.